Hello and welcome back to this YouTube channel. So, as you know, we are discussing here the current affairs, and it is the 12th class regarding the Indian economy. From last 1.5 year, we are discussing all the important current affairs. And if you would go to my channel, you could find out there that we had already completed for polity and governance, international relations, and we are about to complete of Indian economy. After today's or maybe tomorrow, we will take up one more session for this. We will take up then ecology and environment. Then after that, I would take up science and tech. I guess these two more subjects are left, which are very important for our prelims exam. And one more thing which I want to discuss with you guys is from the 1st of July, we are going to start a static portion, a full, a kind of full coaching here, where we would take up the static portion of polity and economy, polity and governance, then economy, then international relations, then after history, then geography and science and tech. So we would take the static part every day. It would be 1 to 2 hour class. Then after that, we will take up every day. We will take up daily current and news analysis. And the most important thing is we would take up the daily quiz session in which we would discuss 10 to 15 questions which would be related to current affairs, which would be related to the static part which we discussed, and which would be related to the previous year questions. And we will take up, we will discuss it in that way how we can use the previous year questions to crack our next exam. So, and one more thing, the medium would be mostly Hindi, and where I could not express, I would try to explain that in English and vice versa. So, without wasting any time, and one more thing, my dear brothers and friends, do please subscribe to this channel if you are visiting this. Subscribe करने से तो कुछ नहीं होता. मुझे तो फ़ायदा मिलेगा, आपका तो कोई नुकसान नहीं होगा. So at least subscribe this channel. You know, like the video. If you don't even like this, at least hit the like button. और दूसरी बात, please stay with me. Trust me, from the 1st of July, you would really appreciate the content which would come from this channel. Trust me on that. So without wasting our time, and let's jump to the topic. It is today we have discussed about the economic nationalism in India. So why this topic? First, I would give you a little idea about economic nationalism. What we do, we try to protect the domestic market. In simple terms, try to protect the domestic market of the country, so that there would be the growth in the domestic market itself. There would be least dependence on the external, on the international market or external imports. So let's see what we have to discuss in it. Here, why it was in news, as we could see that Vice President of India termed economic nationalism as quintessentially fundamental to India's economic growth. So he termed that this economic nationalism is very much important and fundamental to India's economic growth. What is economic nationalism? Here, by definition, we could see that the economic nationalism has been conventionally understood as the economic ideology which favors domestic control of the economy, labor, and capital formation. Its origin is it was given by the Frederick List. He is considered as the initiator of the concept of economic nationalism. Here, in the List's theory of national economics, differed from the doctrine of individual economics and cosmopolitan economics by Adam Smith and Jean Baptiste, uh, say respectively. List asserted that between the individual and entire humanity stands the nation, and he formulated his ideas on his intermediate agency, the nation. List encored how a nation can obtain prosperity, civilization, and power, and his mechanism for this was industrial development, thus erecting tariff barriers to protect the infant industries became the basic aim of List's economic policy. So this economic nationalism we derive it from the Frederick List. So he says that how a nation can be prosperous, how a civilization can become powerful, and how and his mechanisms for this. So it was the industrial development. Thus, he said that we should these tariff benefits should favor our infant industries. You know, the industries which were developing that time. So this is the basic aim of List's economic policy. इन मतलब कि इसके बारे में इकोनॉमिक नेशनलिज्म इसकी जो लिस्ट की थ्योरी थी इट वाज बेस्ड ऑन इकोनॉमिक नेशनलिज्म और ये कह रहा है कि जो हम टैरिफ्स या कोई मतलब लगाते हैं फॉर द फॉरेन इंपोर्ट्स तो हम कैसे उनको फेवर कर सकते हैं कि टू डेवलप आवर डोमेस्टिक इंडस्ट्रीज which are in the very basic state. And also changing nature, the present notion of economic nationalism is concerned with the nation and not with particular economic policies. It may adopt a variety of forms as it may advocate policies of economic liberalism or protectionist policies depending on the situation. So from here we can get that it may adopt a variety of forms as it may advocate policies of economic liberalism or protectionist policies depending on the situation. So, मतलब कि to develop uh, the domestic market or to protect the economy of the nation. So, it depends upon the situation which policy would be required, whether it would be protectionist in which they would increase the taxes or whether it would be liberalism where they would least the government would least interact with the market. So depending upon that these policies would be framed by the government. About economic nationalism in India, its development of idea it developed in India with the context of its subordination to Britain colonial rule. This was also associated with the capitalist expansion on a world scale. First globalization, which was unequal in nature, consisting of the flow of manufactured commodities out of the Europe and primary products into the Europe. Here, अगर हम देखेंगे when the economic nationalism started in India, so we would find its root to the colonial era when the leaders of Indian National Congress or the think tank of that time started to question the English government that they are our East India Company. So we could see it that the earliest reformers of our country they started to question the policy of the for example East India Company or the British, how they violated the Indian markets, how they drained the Indian you know Indian wealth to the markets of the to the European markets. So this question was raised by them, and they started to protect their national markets. So in that regard, we could say that the economic nationalism had originated in the European in the colonial era itself. Here we could see that the early economic critics of colonial rule, cognition of the negative economic consequences of British colonial rule can be traced back to the 1830s in the writings of Raja Ram Mohan Roy. Later, certain intellectuals such as Bhaskar Pandurang Tharkhadar Darkhadkar, Govind Vithal Kunte, popularly known as Bahu Mahajan, and Ramakrishna Vishwanath criticized the British rule for economic exploitation, for economically exploiting India, and also emerging economic nationalists through during the late 19th century and early 20th century. Economic critique widened to political economy of nationhood. It was its most important proponents included Dadabhai Nehruji, Mahadev, Govind Ranade, Ramesh Chandra Dutt, Gopal Krishna Gokhale, G. Subramaniam Iyer, G. V. Joshi, Bal Gangadhar Tilak, and Sunindarnath Banerjee. They realized that India was integrated within global capitalism in a subordinate position as a dependent colonial economy. They also criticized the process of ruralization and deindustrialization to which India was subjected. So, in nutshell, as I already said, that the economic nationalism, it originated in India since the colonial era, when the think tanks like Raja Ram Mohan Rai, they started to question the government policies, they in different way. Then in late 20th century, or in early 20th century or late 19th century, we had Dadabhai Nehruji, Mahadev Govind Ranade, and others like them. They started to question the British, how they are violating or how they are draining the Indian wealth to the European markets, how they are benefiting from Indian wealth, and how they are, uh, in simple words, how their colonial interests drained, or we could say destroyed, the Indian internal economy. About economic nationalism creating Atmanirbhar Bharat, since independence, India has initiated several policies which can be understood as policies of economic nationalism and contribute to the realization of Atmanirbhar Bharat. Promoting domestic industry, then we have several reforms initiated by the government have the potential to promote the growth of domestic manufacturing and services industry. These include schemes such as production incentive schemes, making India national infrastructural pipeline, and insolvency and bankruptcy code. Other initiatives include vocal for local, one district one product scheme, and benefits to MSMEs. Participation in global supply chain, India is undertaking ease of doing business reforms, issuing quality control orders, and standardizing products and services to enhance competitiveness, which will ensure its place in global supply chains. In this regard, initiatives for improving logistics, such as infrastructure development initiatives such as PM Gati Shakti, National Master Plan, National Logistics Policy, Bharat Mala, and Sagar Mala Pariyojana, or others, will help in such integration. Then, in strategic autonomy, we could see India is building its capacity in strategic sectors such as defense, space, clean energy, digital service, etc., and strengthening multilateral partnerships which may reduce the impacts of geopolitics and help frame one independent foreign policy. In research and development, initiatives to promote R&D include the National Research Foundation, Uchatar Avishkar Yojana, impacting research, innovation, and technology, etc. These will make India technologically capable and self-reliant. Here are now the next topic is about government securities or state government guarantees. A working group, why it was in news, we could see that a working group constituted by the Reserve Bank of India made certain recommendations to address issues relating to guarantees extended by the state government. What is state government guarantees? It is a guarantee. A guarantee is a legal obligation for a state to make payments and protect an investor lender from the risk of default by a borrower. Guarantees are basically usually sought when the investors lenders are unwilling to bear the risk of default. As per the Indian Contracts Act 1872, it is a contract to perform the promise or discharge the liability of a third person in case of his default. Article 292 of the Constitution of India extends the executive power of the Union to the giving of guarantees on the securities of the Consolidated Fund of India within such limits, if any, as may be fixed by Parliament. Similar powers are given to state under Article 293. Also, state government often issues guarantees on behalf of various PSEs, cooperative institutions, urban local bodies, etc., to various banks, financial institutions for financing developmental schemes and projects. Guarantee status of state government guarantees. Here we could see that extant state-wise guarantee data for the period 2018-21 suggests that outstanding guarantees constituted less than 10% of their GSDP for the majority of the states. It has, however, been rising over the years for most of the states. The guarantee given by 20 states was 4% of their aggregate GSDP at the end of 2021-22. For several states, The power sector accounted for the largest share of guarantees. Also, states with relatively higher outstanding guarantee levels include Sikkim, which is 12.12%, Telangana 12%, Andhra Pradesh 10%, and Uttar Pradesh 8.8%. Andhra Pradesh has provided significant guarantees to sectors of agriculture and water supply, sanitation, housing, and urban development. Here is the importance of government guarantees. We could see that to improve viability of projects or activities undertaken by government entities with significant social and economic benefits, to enable public sector companies to raise resources at lower interest charges or on more favorable terms, and also fulfill requirement in case sovereign guarantees is a precondition for concessional loans from bilateral or multilateral agencies. Then we have Guarantee Redemption Fund. GRF has been established in the public account of India for redemption of guarantees given to central public sector enterprises, financial institutions by the central government. It is funded through budgetary appropriations under the head transfer to Guarantee Redemption Fund through the demands for grants of the Department of Economic Affairs. Guidelines for guarantee policy of Government of India 2022. Here are some guidelines. We could see that guarantees may be given only for principal amount and normal interest component of the underlying loan. The Fiscal Responsibility and Budget Management Act 2023 prescribe a limit of 0.5% of GDP for guarantees to be given in any financial year. So limit is 0.5% of the GDP. If, if this limit is exceeded owing to unforeseen circumstances, the finance minister is required to make a statement in both houses of the parliament explaining the deviation. Guarantees may not be extended for external commercial borrowings. State governments may not extend guarantee for more than 80% of the project loans depending on the conditions imposed by the lender. Guarantees once approved shall not be transferred to any other agency without the prior approval of the finance department. Also, government guarantees shall not be provided to private sector companies and institutions. Appropriate preconditions may be specified by the government while giving the guarantees, for example, period of guarantee. Now, coming to the third topic of today's discussion, it is the insurance sector in India. Why it was in news? The Standing Committee on Finance presented a report on the performance review and regulations of the insurance sector to the Lok Sabha. Status of insurance sector in India. Insurance penetration increased from 2.71% in 2001 to 4.2% in 2021-22. The global average was 7% in 2021-22. Insurance density has increased from 11.5 in 2001 to 2 to 91 in 2021-22. The global average was 874 in 2021-22. Insurance business. India ranked 10th in the global insurance business with a market share of 1.85% in 2021. Number of insurers registered increased from 6 in 2000 to 70 in June 2023. Also, sector concentration. Indian insurance sector is heavily tilted towards the life insurance segment, which has a share of 76%. Globally, the share of the life insurance business is total premiums was 43.7% in 2020. Regulation of the insurance sector in India. We have Insurance Act 1938. It provides the legislative framework for the functioning of insurance business and regulations the relationship between an insurer, its policyholder, its shareholders, and the regulator. Insurance Regulatory and Development Authority of India (IRDAI). It is a statutory body established under the provisions of the Insurance Regulation and Development Authority Act 1999. Its functions include regulation, promotion, and ensuring orderly growth of the insurance business and reinsurance business. It also certifies insurance companies, protects the interests of the policyholders, and adjudicates disputes. Insurance Division of the Department of Financial Services. The Ministry of Finance is responsible for policy formulation and administration of the following acts: the Insurance Act 1938, the Life Insurance Corporation Act 1956, the General Insurance Business Nationalization Act 1972 and the IRDA Act 1999 and the Actuaries Act 2000. Issues and recommendations highlighted by the committee. Here are the issues: micro insurance distribution, small size of installments coupled with the high transaction and service delivery costs, absence of business model that can attract good intermediaries, lack of knowledge regarding insurance. Here are some recommendations. New affordable micro insurance products need to be developed for the financial protection and security of the low income and vulnerable sections of the society. It may require encouraging smaller niche players in various geographical areas with reduction in capital requirement of rupees 10,000 crore for each such player. Then composite licensing. Here are the issues. Regulation of IRDA do not allow composite licensing, that is for an insurer to undertake life, general or health insurance under one entity. Presently, life insurers can only offer life insurance products, while generating insurers can offer non-life insurance products, etc. Here are recommendations: allow composite licensing, enabling a single insurance entity to offer both life and non-life insurance products. Composite licensing can cut costs and compliance hassles for insurers. Composite licensing can boost insurance reach and awareness in India, as customers can get all-in-one insurance from one provider with lower premiums and easier claims. Here in health insurance, according to Niti Aayog's report, around 30% of the population is devoid of health insurance. This uncovered population is termed as the missing middle. Steps such as developing simple and standardized health insurance products, sharing government data and information infrastructure, and partial financing of health insurance should be initiated. Then we have performance of public sector insurance companies. They lack adequate capital and have lagging insolvency ratios. Causes for performance decline include overexposure in health insurance business, wage revisions, and COVID-19 losses, etc. Here are recommendations: an appropriate strategic roadmap should be adopted to improve their competitiveness and enable them to attract sufficient capital and talent. In government insurance schemes, there are issues such as delay in processing of claim settlement, high premium rates, and others. Here, what are recommendations? Effective mechanisms should be devised to expedite the process of claim settlement, and premiums should be made more affordable. Coming to the fourth article of today's discussion, it is the card networks in India. The Reserve Bank of India has ordered a certain card networks to stop unauthorized payments made using business cards. The RBI said that the card network was allowing business to make payments to entities that were not authorized to accept card payments, and transactions did not comply with KYC norms. The intermediary in the above case pooled a large amount of funds into an account that was not a designated account under the Payments and Settlements System Act 2007 PSS Act. What is a card network? A card network, they are developed to utilize one mode of payment pay to goods and services at multiple merchants and avoid carrying cash around. The authorized card networks tie up with banks, non-banks for the issuance of debit card or credit card or prepaid cards. Card networks connect banks, merchants, and customers, card users, so that transactions can be carried out smoothly and securely. A fee is charged to the business by companies that process its debit and credit card transactions, known as merchant discount rate. Card issuer banks typically dominate the choice of card networks that will be issued to their customers, while providing a debit or a credit card, and the customers have little choice in the matter. However, RBI has asked card issuers to provide customers the option to choose from multiple card networks from October 1, 2023. The RBI also said that the card issuers should not enter into any arrangement or agreement with the card networks that restrain from them from taking the service of other card networks. About card network market in India, authorized card networks in India, we have Visa, MasterCard, RuPay, Diners Club, and American Express. RuPay is India's indigenous payment network launched by NPCI to facilitate India's entry into the global payment market. To ensure greater acceptability of the RuPay cards in foreign markets, NPCI has partnered with the Discover Financial Services USA and Japan Credit Bureau Japan. And also debit cards segment is dominated by RuPay, which has around 700 million cards and a 65% market share. Of the total 28.8 crore RuPay debit cards, about 28.1 crore come from public sector banks under the government scheme as of Feb 2023. Visa and Mastercard dominate the credit card market. Together, they own 90% of India's credit card market. The credit card portfolio of RuPay network is yet to see a spike. National Payment Corporation of India (Genesis NPCI) is an initiative of RBI and Indian Banks Association under the provisions of the PSS Act 2007 to create a robust payment and settlement infrastructure in India. It is a statutory body. It has been incorporated as a not-for-profit company under the provisions of Section 25 of Companies Act 1956, now Section 8 of Companies Act 2013. Products payments products developed by NPCI include Immediate Payment Service (IMPS), National Automated Clearing House (NACH), Aadhaar-enabled payment system (AEPS), and Unified Payment Interface (UPI), and etc. Regulations of card network ecosystem in India. RBI has the primary regulate is the as the primary regulator. The Reserve Bank of India is responsible for overseeing and regulating payment system in India, including card networks under the PSS Act 2007. Governing legislation. PSS Act 2007 defines a payment system as a system that enables payment to be effected between a payer and a beneficiary, involving clearing payment, a settlement service, or all of them. Payment systems includes the systems enabling credit card operations, debit card operations, smart card operations, money transfer operations, or similar operations. Although the definition does not include a stock exchange. Here we have payment aggregator. We could see that Juspay, Zoho, and Decentro has received final authorization from Reserve Bank of India for payment aggregator licenses. These payment aggregators are the entities that facilitate e-commerce sites and merchants to accept various payment instruments from the customers without the need for merchants to create a separate payment integration system of their own. In the process, they receive payments from customers, pool and transfer them on to the merchants. PAs are different from payment gateways as later only provides technological infrastructure to facilitate payment transaction without any involvement in fund handling. Now, the next topic is the Smart Cities Mission. The Standing Committee on Housing and Urban Affairs presented its report on Smart Cities Mission and Evolution Progress highlighted by this report. Financial progress out of its proposed share, the central government has realized 86% up to December 2023, while 46 smart cities have received 100% of the central funds. Only 28 cities have received 100% of their share of funds from state and urban local bodies. Additional funding source. While half of cities should not undertake any projects under the Triple P model, only 6 cities could generate funds through loans for smart cities projects. Physical progress till December 2023, out of 7,970 projects taken up by smart cities, 6,419 projects have been completed. Progress of work is from 80% to 100% in 57 cities, amongst which Madurai is the only smart city which has completed 100% of its projects. About Smart Cities Mission. It is a centrally sponsored scheme launched by Ministry of Housing and Urban Affairs in 2015. Its objective is to promote cities that provide core infrastructure, clean and sustainable environment, and give a decent quality of life to their citizens through the application of smart solutions. Smart cities, 100 cities have been selected for development as smart cities. The timeline of 5 years for completion of the projects was set between 2019 and 2023. However, the mission is now extended to June 2024. funding. Central government gives financial support to the extent of rupees 48 crore over 5 years on an average rupees 100 crore per city per year. An equal amount on a matching basis is being provided by the state urban local bodies, apart from 13 Himalayan and northeastern states where the sharing ratio has been revised to 90 to 10. Also, additional resources are raised through convergence from ULB's own funds, grants under Finance Commission, innovative finance mechanisms such as municipal bonds, other government programs and borrowings, public-private partnership emphasis has been given on the participation of private sector through public-private partnership. Core elements of a smart city: we have communities at the core of planning and implementation, then more from less able to generate greater outcomes with the use of lesser resources. Cooperative and competitive federalism: cities selected through competition flexibility to implement projects. Then we have integration, innovation, sustainability, innovating methods integrated and sustainable solutions. Then we have technology as means not the goal, careful selection of technology relevant to the context of cities. Then convergence, sectorial and financial convergence. Now, coming to the next topic, it is Prime Minister Mega Integrated Textile Region and Apparel PM Mitra Park Scheme. Committee on Estimates presented the report on environment through PM Mega Integrated Textile Region and Apparel PM Mitra Park Scheme and revival efforts for the Sikh textile units and PSUs. About PM Mitra Park scheme, it is inspired by 5F vision, which is forum to fiber to factory to fashion to foreign. Of Prime Minister's Minister to propel India into a leading global hub for textile manufacturing and exports. Its main objective is develop integrated large-scale and modern industrial infrastructure facility, including plug-and-play facilities for total value chain of the textile industry. It reduces logistics costs by housing entire value chain at one location and improve competitiveness of the Indian textiles. Help India in attracting investment, boosting employment generation, and position itself strongly in the global textile market through augmentation of export potential. Features of Mitra Parks to enable scale: the minimum estimated area per Mitra Parks is 1000 acres. Mitra Parks will offer the opportunity to create an integrated textile value chain right from spinning, weaving, processing, and printing to garment manufacturing, accessories making at one location. Mitra Parks can be either a greenfield or brownfield. In governance, we have a special purpose vehicle owned by center and state government jointly will be set up for each park, which will oversee the implementation of the project. Financial support: Ministry of Textiles will provide financial assistance up to rupees 800 crores per park for greenfield projects and up to rupees 500 crore per parks of brownfield projects. Union government will provide financial support in the form of development capital support for greenfield Mitra parks at DCS of 30% of project costs with a cap of 500 crore per park will be offered. DCS at 30% of project costs of balance infrastructure needs and other support facilities with a cap of 2000 crore per brownfield park will be provided. Also, DCS, which is development capital support, will finance the development of a core infrastructure comprising incubation center, plug and play facility, developed factory sites, roads, power, water and waste water system, common processing house and others. Commercial development: CD is a limited area up to 10% of the park area on self-financial model will enhance viability of the park and help maintenance of common assets and facilities by SPVs even after scheme's completion. Competitive incentive support: SEIS of up to rupees 300 crore per park will incentivize early operationalization and quick scale up. Redemptions to improve PM Mitra Park scheme. We have comprehensive policy. Ministry should frame a comprehensive national textile policy with a view to make Indian textile industry globally competitive by incorporating the best international practices and industry-oriented proactive aspects of state textile policies and schemes. Review of selection procedures. Ministry should review the selection procedure with a view to set up more PM Mitra parks to enable speedy recovery of the Indian textile sector. Expedite SPV formation. Ministry should find out reasons for delay in formation of SPVs in remaining states and in assisting them for SPV formation at the earliest. Out of 7 approved proposals, only 2 states, Gujarat and Uttar Pradesh, have incorporated SPVs, and other states are still in process. Then tax regimes rationalization. State government extended stamp duty exemption, concession and on land rates, state goods and service tax reimbursement. Union government should consider extending similar central tax duty exemption, including central goods and service tax reimbursement and import duty rationalization to curb low cost undervalued import of Chinese knitted fabric. Also, special incentives. There should be provisions for special incentives to attract women entrepreneurs. The ministry should make mandatory provisions for basic amenities for female workers, such as crèche, crèche facility, medical care, flexible working hours, and assistance for setting up women manufacturing units. Vertical integration. Take proactive steps to ensure vertical integration of power loom sector beyond the ambit of PM Mitra parks to convert the Indian textile and apparel industry from fragmented to integrated and from unorganized to organized. Pradhan Mantri Matsya Kisan Samriddhi Shah Yojana. This is the next article which we have to discuss. The Union Cabinet approved the Pradhan Mantri Matsya Kisan Samriddhi Shah Yojana PMMKSSY. About the scheme, it is the central sector sub scheme. The scheme is under the central sector component of the Pradhan Mantri Matsya Sampada. Objective, it is the gradual formalization of the unorganized fisheries sector, facilitating institutional finance to fisheries sector, micro and small enterprises, providing a one-time incentive to beneficiaries for purchasing aquaculture insurance, incentivizing for improving fisheries sector value chain efficiencies, incentivizing for adoption and expansion of fish and fishery product safety and quality assurance system. Funding, total outlay of 6,000 crore rupees, of which 50% will come from public finance, including the World Bank and the AFD French Development Agency external financing, and 50% will be contributed by the beneficiaries from the private sector. Duration, the scheme will be implemented for 4 years from financial year 23-24 to financial year 26-27 across all the states and UTs. Implementation strategy of MKSSY. Component 1, a formalization of the fisheries sector and facilitating access of fisheries micro enterprises to Government of India program for the financing of working capital. National Fisheries Digital Platform will be created and all the stakeholders will be mobilized to register on it. The National Fisheries Digital Platform will serve multiple functions, including disbursement of financial incentives. Then component 1B, facilitating the adoption of aquaculture insurance. It is proposed to facilitate the creation of appropriate insurance products and to cover at least 1 lakh hectares of aquaculture farms. SCs, STs, and women beneficiaries would be provided an additional incentive at 10% of the incentives payable for general categories. Component 2, we have supporting micro enterprises to improve fisheries sector value chain efficiencies. Then we have component 3, facilitating adoption and expansion of fish and fishery product safety and quality assurance system. Then component 4, project management, monitoring and reporting. It is proposed to set up project management units to manage, implement, monitor and evaluate project activities. About Pradhan Mantri Matsya Sampada Yojana, it aims to bring blue revolution through sustainable, responsible and holistic development of fisheries sector, including welfare of fish farmers. The Pradhan Mantri Matsya Sampada Yojana is an umbrella scheme under two separate components. Central sector scheme, the entire project unit cost will be borne by central government, and centrally sponsored scheme, the entire project unit cost will be shared between center and state. It has been implemented in all states and union territories for a period of 5 years from 2021 to 24-25 with investment of rupees 20,050 crore. Targets of PMMSY increasing fish production to 22 million metric tons by 2024-25 from 13.75 million metric tons in 2018-19, increasing contribution of fisheries sector to the agriculture GVA to about 9% by 2024-25 from 7.828% in 2018-19, doubling export earning to rupees 1 lakh crore by 2024-25 from rupees 46,589 crores in 2018-19. Now coming to the next article, which is fertilizer sector in India. Ministry of Chemicals and Fertilizers issued guidelines regarding the reasonableness of the maximum retail prices of phosphatic and potassic fertilizers under the nutrient-based subsidy policy. Through these guidelines, government has brought P&K fertilizers under the NBS support under reasonable pricing controls. NBS fertilizers, unlike urea, whose MRP is fixed by the government, are technically controlled. Under NBS scheme, their MRPs are supposed to be market determined and set by the individual companies selling them. About nutrient-based subsidy policy, objective government introduced the NBS policy in 2010 with an aim to provide fertilizers to the farmers of the subsidized prices. It has been approved for the implementation up to financial year 25-26. It has been formed under Fertilizer Control Order 1985 issued under Essential Commodities Act 1955. FCO lays down as to what substances qualify for use as fertilizers in the soil, product-wise specification, procedure for obtaining license registration as manufacturer dealer in fertilizers, and conditions to be fulfilled for trading thereof, and others. Its eligibility NBS is applicable for 25 grades of P&K fertilizers, namely diammonium phosphate, muriate of potash, monoammonium phosphate, triple superphosphate, and others. Government announces a fixed rate of subsidy in rupees per kg basis on each primary nutrient of subsidized P&K fertilizer, namely nitrogen, phosphate, potash, and sulfur on annual basis. Subsidy recommendation interministerial committee recommends per nutrient subsidy for NPK and S before the start of the financial year for decision by Department of Fertilizers. Key provisions of the guidelines: we have implementation. These guidelines will be effective retrospectively from April 1, 2023. Profit percentage differential profit percentage will be allowed for P and K fertilizer companies based on their category, that is different profit percentage for manufacturers, importers, manufacturers, and integrated. Basis of evolution of reasonableness of MRPs will be total costs of sales, that is cost of production, import, administrative overheads, selling and distribution overheads, net interest and financing charges. Goods and service tax will be excluded from evaluation of reasonableness of MRPs. Applicability reasonability of MRPs will be evaluated for all fertilizer grades for which subsidy is received by companies under the NBS scheme. About assessment, companies will self-assess unreasonable profit earned by them and refund unreasonable profit to Department of Fertilizers. Now coming to the last topic of today's discussion, it is the FDI in space sector. Government recently relaxed rules to allow 100% foreign direct investment in space sector. Existing FDI policy in space sector: earlier FDI was permitted in the establishment and operation of satellites through the government approval route only. Amended FDI policy: 100% FDI is allowed in space sector in line with the vision and strategy under the Indian Space Policy 2023. The liberalized entry routes are aimed to attract potential investors to invest in Indian companies in space. FDI limit for satellite subsector seeking 100% under automatic route. Manufacturers of components and systems, subsystems for satellites, ground segments, and user segment. Then we have up to 74% under automatic route. Satellites manufacture and operation satellite data products and ground segments and user segment. Beyond 74%, these activities are under government route. Then we have up to 49% under automatic route. Launch vehicles and associated system of subsystems, creation of spaceports for launching and receiving spacecraft. Then beyond 49%, these activities are under government route. So I guess this is for today. See you tomorrow. No, we have steps taken by India to support private sector in space. We have Indian Space Association launched in 2021. It is the apex non-profit industry body exclusively working towards successful exploration, collaboration, and development of private and public space industry in India. Antrix Corporation Limited, incorporated as a marketing arm of ISRO, it handles ISRO's commercial deals for satellites and launch vehicles with foreign customers. Then we have Indian National Space Promotion and Authorization Center, IN Space, and autonomous nodal agency to facilitate private sector engagement in space activities. Then we have to encourage private investment. The government has also exempted private launch services companies from paying GST when they launch satellites. And also India's space policy 2023 suggests that the private sector is critical stakeholder in the early value chain of the space economy.